everybody. Luke Gromen, FFTT. Hope everybody is doing well this weekend and had a great weekend. We're going to jump right into the two things that grabbed my attention recently and then highlight a couple things we were asked about in the comments section on the Twitter feed. So first off, the first thing, of course, is Donald Trump this afternoon said tariffs on $200 billion of Chinese goods will increase to 25%. And he blamed slow progress on trade talks. And it's an important data point, I guess, as we sit here now. Dow down 400 or 500 points in the futures. Dollar was up a bit. Interestingly, gold's up a bit. But ultimately, de-globalization is terrible for pretty much anything in risk except for dollars, treasuries, and maybe gold. And so it's going to be real interesting, very interesting to see how this plays out over the course of the week. Because to me, the key question is Trump, is this a sign that talks have completely broken down? Or is this a sign that we need a deal and we need a deal now? And if we get a deal faster as a result of this, or we get no deal, are, I think, two very different outcomes. So I'll be watching for clues on that. Don't have a great feel either way at this point, but reflexive action, I think, is going to be sell everything and buy dollars and treasuries. So that's the first thing. The second thing is that both Bloomberg and FT had articles this week noting that central bank gold buying in the first quarter of 2019 was up 68% year over year, highest number since 2013 in the first quarter, highest quarterly total. And it remains a very big non-sequitur to the prevailing consensus narrative that of this dollar shortage. And there is a dollar shortage out there. But it begs the question, why are central banks who are short dollars selling dollars to buy gold? There's no easy pat answers that fit into the sort of the existing narrative. And so that to me is very interesting. That brings me to the first question here. We were asked, how is too much physical buying drive gold prices down? We tweeted about this once or twice this week. We've tweeted about it in the past. It is akin to a bank run, is the way to think about it. And so in the same way that strong demand for collateral from Lehman Brothers eventually drove Lehman bonds down in price, that's effectively what's been happening in gold markets since 2013 and 2Q13 in particular, in my opinion. The reason this is gold unallocated accounts are merely levered liabilities of the gold bullion banking system, and so the gold price on our screens is a liability. It's not an asset. It's akin to the price of Lehman bonds, and so unallocated gold is levered 100x or more paper to physical, and so conceptually, if you have 1 ounce outstanding for every 100 ounces of paper, then as soon as somebody takes that physical out of the system, and those are strong hands, generally speaking, eastward that gold has been flowing, then the value of the other 99 paper ounces, unbacked paper ounces, are whatever they're going to get cash settled at. Now that's that in case of a force majeure. Now that is a conceptual look at it. From a mechanical standpoint, it's been explained to me that what happens is you get too much physical buying, you end up in highly levered paper markets that inverts the gold lending curve, and that is a problem for the bullion banking system where they borrow short and lend long. So once that curve inverts, it drives what's effectively hedging activity, which entails selling at the front end of the curve, and you end up with spot gold selling off. But I think the important thing is the price we see on our screens is a liability. It is the liability that drives the price of gold, and that's a liability that is perched in a highly levered capacity on a very small amount of physical. And so when you remove collateral from a highly levered system in finance, the price of the liabilities falls. It's just a bank run. So that's how we describe that. The other question we had a number of questions on was the Fed funds rate versus interest on excess reserves. It's a pretty technical topic, and it is, in short, the simple version is that foreign demand of treasuries, starting with central banks, went away in 3Q14 by and large. More recently, in the second half of last year, in the fourth quarter last year, the cost for foreigners to hedge treasuries became prohibitively expensive. And so the net of it is that the U.S. domestic private sector has been having to fund more and more of what are rising U.S. deficits. And so as this is happening, this is effectively sucking cash out of the U.S. banking system into treasuries, and so the U.S. is crowding out its own private sector, is what's happening. And this is a temperature gauge of that. Now, there are very easy technical fixes to this, mechanical fixes to this. The Fed cutting IOER last week may have been the first of those. We'll see how effective it is. But in the same way, it's saying there's an easy technical fix is just like saying, well, all we have to do in 2005 is stop issuing, ninja loans, and the bank, the mortgage, the housing bubble will stop inflating. Obviously, that is technically true last week. So I'm going to jump at this point. Those hopefully everyone's doing well. Like I said, this weekend. If you're interested in what we're up to, check out FFTT-LLC.com. Also, if you like these updates, check out on our website FFTT-LLC.com under subscribe to FFTT. The tree rings tab. Getting a lot of great feedback. Every Friday we publish 10 most interesting things that grabbed us that week. There's charts, there's synthesis, and it's a 7 to 10 page document, and people, like I said, we're really getting great favorable feedback from customers on it. So at any rate, hope everyone has a great week, and we look forward to catching up with you next Sunday night. Take care, everybody.